For this multitask question, we have been given two tasks. We are given some background information relating to two companies. We have Caswick Company, who acquired 80% of the share capital of the Derwent Company on 1st June 2005. The question then provides us with a statement of profit and loss for both the companies for the year ended 31st May 2006. So the pattern of the background information shows that we have a consolidated group accounts question. Task 1 asks us to use this information to complete the following financial statements. We have got revenue, cost of sales, expenses, and profit. And therefore, we are looking at a consolidated statement of profit and loss account. At the end of the background information, we also have an intra-group adjustment that we will need to incorporate while calculating the consolidated figures. Task 2, we are then asked if the existence of any of the following factors illustrate the existence of a parent-subsidiary relationship. This task is independent of the background information and task 1. Now let's move forward to solve first task. And for this, let's analyze the group structure in the backdrop of the information that relates to task 1. We can see that Caswick acquired 80% of the share capital of Derwent on the 1st of June 2005. As Caswick owns more than 50% of the share capital of Derwent, it is the parent company, and Derwent is therefore the subsidiary company. The remaining 20% of the share capital is owned by the shareholders who don't control the company and are thus called the non-controlling interest, or NCI. In such a situation, when we have a group, we will need to prepare consolidated financial statements. It is also important to consider the date of acquisition of the subsidiary company, which in our case is 1st of June 2005. That is the start of the year. This essentially means that we will be consolidating the subsidiary company for the entire year. Had it been a mid-year acquisition, then only the post-acquisition results would have been considered for the purposes of consolidation. For many of the consolidated balances we prepare in the process of consolidation, we will be adding together Caswick's figures with those of the Derwent's figures on line-by-line basis. However, we will need to make some adjustments in respect of the intergroup trading transactions between the group. Moving forward towards task 1, the first thing that we have to do by looking at the drop-down menu is to decide the title of the statement we have been asked to prepare. The first option, Consolidated Statement of Profit or Loss as at 31st May 2006, is not the right option, as we know that profit or loss statement is prepared for a period and not at a specific point in time. The titles in the second and fourth option are used when we are preparing a single company's financial statement. So both of them are also not the right options. Another reason to reject fourth option is that it is being prepared at a specific date, which is not the case with profit or loss statement as they're prepared for a period of time. This leaves us with the third option, Consolidated Statement of Profit or Loss for the year ended 31st May 2006, which is the right option here. The next step is to look at each of the individual balances line by line and decide what needs to be included. So first of all, for our revenue figure, we can see that the revenue for Caswick was 8.4 million, which will be added to the revenue for Derwent, which is 3.2 million. What we're also told in the information just underneath over here is that during the year, Caswick Company sold goods costing 1 million to Derwent Company for a price of 1.5 million. Now, any intra-group purchases and sales made are not allowed to be included in consolidated accounts. And that's because consolidated accounts are made on the premise that all the entries in a group are part of one fiscal unit. And thus, all transactions between the group companies are eliminated during the process of consolidation. Therefore, we will need to remove the sale of these goods from Caswick's figures. I have prepared a working pro forma to better understand the process and impact of adjustments. Let's move towards the pro forma. So after bringing in the sales figures of both the companies, we will deduct the amount of intra-group sales from the amount of revenue, that is minus 1.5 million. This will give us the adjusted figure of total revenue of 10.1 million. Now, looking at our drop-down menu for our consolidated statements down here, let's see what we've got over here. So the first option that we've got is 8.4 million plus 3.2 million minus 1.5 million. Now, this 1.5 million that we are deducting from over here is exactly the same amount that is of the intragroup sales. So the first option over here is the right option. Going back, the next balance to prepare is our cost of sales figure. Once again, looking at the information provided, we can see that Coswic's cost of sales were 4.6 million. Adding on to this is the Derwent's cost of sales, which amounted to 1.7 million. Now, remembering that we had an intragroup sale purchase transaction where Caswick, the parent company, sold to Derwent, the subsidiary company. In other words, Derwent purchased goods from Caswick. Therefore, the purchase in Derwent's accounts needs to be removed. So we are going to remove the amount of 1.5 million and process it as an adjustment to the consolidated accounts. In addition to this, we are also told at the end of the year on 31st May, 30% of these goods remained in Derwent's inventories as unsold goods. Now, this has an element of unrealized profit. When Keswick made a sale to Derwent, it made a profit. Keswick bought the goods for 1 million and then sold the same goods for 1.5 million to Derwent. It has therefore made a profit of 500,000. Now, out of the total profit of 500,000, 70% of the profit has been realized by the group, for which no adjustment needs to be made. However, 30% of the profit that comes to 150,000 remains unrealized and now forms part of the cost of closing inventory to Derwent. In the consolidated accounts, we are not allowed to recognize any unrealized profit. We will therefore need to remove the amount of unrealized profit. As this profit now forms part of the cost of Derwent's closing inventory balance, we will need to reduce the amount of inventory by 150,000. which has a consequential impact of increasing the amount of cost of sales by 150,000. Therefore, we will need to add this back to our cost of sales figure as an adjustment. This leads to consolidated cost of sales figure of 4,950,000. Looking at the drop-down menu for cost of sales, the correct option is going to be the very first option. That is 4.6 million plus 1.7 million minus 1.5 million of intra-group purchases plus 30% of 500,000. That is the amount of unrealized profit. The rest of the figures don't have a drop-down menu and are basically based on my earlier calculations of the amount of revenue and cost of sales. So let's first complete the workings and then fill in the pro forma answer we have been provided with. Deducting the amount of cost of sales from revenue gives us a gross profit figure of 5,150,000. As can be seen from the question, there are no other adjustments apart from the intergroup trading adjustment that we have already processed. So what remains is a line-by-line addition of the figures of both the companies. That's the easier part. Adding 1.5 million of selling expenses of Caswick to 510,000 of Derwent's gives us a total selling expenses of 2,010,000. Same applies to the general and administrative expenses. 700,000 plus 450,000 gives us a total of 1,150,000. This results in a consolidated profit before income taxes figure of 1,990,000. Income tax expenses will also be simply added up. 600,000 plus 140,000 gives us a total of $740,000. The final figures are for the amount of profit, which comes to $1,250,000. The bottom line also calculates individual profits for both Caswick and Derwent, and they are the same as given in the question. Now let's just punch these figures into our format. So the amount of gross profit comes to 5,150,000. Selling expenses total to 2,010,000. General and administrative expenses total to 1,150,000. This gives a total profit before income taxes figure of 1,990,000. The total income tax expense comes to 740,000, which gives us a bottom line figure of 1,250,000 as the profit. Looking at the remaining information to complete for task 1, we need to determine as to what amount of profit is attributable to the owners of the parent and what goes to the non-controlling interest. So what owners of the group are being able to pocket by the end of the day is the amount of group's profit for the year after deducting what belongs to the non-controlling interest. So option 1 is the right option. All other options are incorrect. But before moving forward, let's see why other options are incorrect. Second option is attributing to the group its own profit as well as that of NCI, which is incorrect. Third option talks about Caswick's own profit only, completely ignoring that question relates to attribution of group's profit share to parent, which must also include share of subsidiary profit. Fourth option is also incorrect as it is ignoring 20% of NCI share. So let's select option 1. The final task is to calculate the amount of non-controlling interest, which is fairly simple. As we can see that Derwent's profit for the year is 400,000. The group only owns 80% of this profit and the rest of it belongs to the non-controlling interest. So we will take 20% of 400,000 to calculate the amount of profit attributable to NCI, which comes to 80,000. Let's put this amount into the correct box. Ta-da! We have completed the first task. Now let's move forward to the second task, where we need to decide if the existence of each of the following factors illustrate the existence of a parent-subsidiary relationship. The key to solving this part is appreciation of the fact that the parent-subsidiary relationship exists where the parent controls the subsidiary. And control exists where, number 1, the parent has power over the investee. Number 2, parent has exposure or right to variable returns, which is normally an attribute of ordinary equity shares. And lastly, the ability to use its power over the investee, that is the decision-making power. Let's see what are the options. Number 1, greater than 50% of the equity shares being held by an investor. Greater than 50% does indicate the existence of a parent-subsidiary relationship as it indicates control. So this is the correct option. Number 2, non-controlling interest of 10%. This means that there would be a controlling interest of 90%, which would indicate a parent-subsidiary relationship. So this is also a parent-subsidiary relationship. Third is 50% of all debt being held by an investor. This will make you a creditor of the company and entitle you to receive a fixed interest income. But you can't exercise control over the company's decisions, nor do you have exposure to variable returns. It is therefore not a parent-subsidiary relationship. Fourth, greater than 50% of the preference shares being held by an investor. Preference shares are not subject to variable returns and are entitled to get a fixed return, which is in the nature of interest. And this attribute makes them a financial liability of the company rather than an ownership interest. So this one also doesn't qualify as a parent-subsidiary relationship. The next one is control. It is a yes. We just recalled that having control over another company is the litmus test of having a parent-subsidiary relationship. The next one looks at greater than 50% shares and debt being held by an investor. Preference shares are non-equity ownership. These are often the non-voting shares and are entitled to fixed return, and therefore, just like debt, don't constitute control over the company. So this also doesn't qualify for the parent-subsidiary relationship. The second last one is significant influence. Well, significant influence exists where the investor holds less than 50% stake or control in the company, and it is thus termed as an associate of the parent rather than a subsidiary. It is therefore not a parent-subsidiary relationship. And finally, 100% of equity shares being held by an investor. This one, without an iota of doubt, is a parent-subsidiary relationship, as parent has absolute control over the subsidiary.